Hello everyone, Cale Smith again here. I previously posted a video on all the recent stock market volatility, and if you watched that, you saw that one of the points in there was that this recent volatility was actually not all that uncommon, in spite of some of the pretty breathless headlines over the last few weeks. In this video though, which is a total of 23 slides including this cover shot, I'm going to be talking about something that is actually pretty rare, and that is the recently passed Tax Cuts and Jobs Act, or TCJA. We haven't seen a major tax reform here in the US in about 15 years, and while it seemed like there were a lot of headlines about the politics and the political battles of the recent tax reform, there wasn't so much mainstream media coverage of what it actually meant for taxpayers like us. And you know, probably like a lot of you, I'm certainly curious to know whether I'm going to be paying more or less in taxes from now on. So this video slideshow is really my attempt to summarize some of the highlights of the recent tax reform, and from two different perspectives, really. The first few slides are really how I would analyze the impact of the cuts, really from the stock market perspective in general. So, you know, kind of wearing my stock analyst hat. The majority of this presentation, though, is done from a personal financial planning perspective, as opposed to that stock analyst or portfolio manager perspective. My main focus here is to highlight some areas where this recent tax reform might impact you and your family too, as opposed to, you know, how it might impact, say, the earnings of the companies we own shares of in the Tarpon Fund. So after the first few slides where I'm wearing my stock analyst hat, I'm going to try to make it obvious when I shift to start looking at all of this through that personal financial planning lens, which again is really the heart of this slideshow. Okay. Here is the usual compliance disclaimer. Although in this case I would underscore the part about this not being tax advice specifically. I think you all realize that I'm a stock analyst and not a CPA. You may also be aware that later this year, IIM is going to soon be offering full boat, fee-only financial planning services to all of our investors, and that tax planning is absolutely a part of that. But this video is not that either. This is me, your sort of overly anal and analytical portfolio manager, trying to get my arms around tax reform and discovering along the way a few areas that I thought you, our investors, might also want to be aware of, or possibly talk to your own CPA about. Okay, so let's hit the highlights. And again, first, this is just kind of wearing my market or stock analyst hat. Here are what I think are probably the three most relevant aspects of the recent tax reform from that market perspective, from that analyst perspective, and we're just going to kind of cover these pretty quickly. Prior to the tax reform bill, the U.S. had the highest corporate tax rate among major industrialized countries. You can see that all the way on the left here in that dark blue bar. The green bar in the middle is where we are now, though, after this tax reform. And you'll note that that is below average among the world's developed economies. And while it is true that most corporations already pay a lower effective rate than is shown here anyway, for a number of reasons ranging from accounting policies to subsidies to deductions and shelters and favorable deals, the reality is that from a macroeconomic perspective, this tax reform should create better incentives and boost competitiveness for U.S. companies. Here is a chart showing the tax burden by country, which I also think is important, or at least it's relevant, and in terms of assessing how this thing might favorably impact U.S. companies for investors like us in them. And what this chart is telling us is that prior to the tax reform bill's passage, U.S. individuals and companies paid less in taxes as a percentage of the U.S. economy, despite having higher tax rates like we just saw in that last slide. So, you know, economists attribute that fact really more to the sort of the vibrancy and the robustness of the U.S. economy than to the tax code itself. Although, admittedly, many folks would still like to see a more simple tax code and fewer loopholes, even after the recent reform. This slide in particular, I think, gets at one of the big motivations for cutting corporate taxes as part of this deal. This idea that high statutory tax rates were leading to poor incentives for both individuals and corporations in the U.S. That necessarily wasn't just politicians talking. There's really some truth to that, as hopefully you can kind of tell from here. So if the last two slides were the positive, big picture, macro-based aspects of the upside of tax reform for investors like us, and as investors, we own very small stakes in corporate America, and we want it to be successful so our portfolios will benefit. Then this slide is probably the negative aspect of the tax reform, at least right now. It does not, and this slide doesn't yet even incorporate the next 10 years of projected budget deficits, which between this tax reform and the budget that the White House released earlier this past week, that deficit in about 10 years will likely reach around $11 trillion, of which right around 1.5 to 1.7 trillion of which is due specifically to the TCJA. As per the notes there at the bottom, the U.S. budget deficit adds over $500 billion to the total federal debt each year. The deficit, as you can also tell, has absolutely shrunk as the economy has improved the last few years. But there's also no arguing that we are far from a balanced budget, let alone the surpluses like we had 20-odd years ago. That last bullet at the bottom is probably the most understated one in this presentation. Spending and budget battles in D.C. from here on out or will probably be contentious if they're not done in a budget neutral way. So unfortunately, if you are hoping for less political polarization in D.C., this chart might suggest that you should gird your loins or something during budget seasons for the foreseeable future. Incidentally, I really can't help but look at charts like this without thinking that old Warren Buffett probably had it right when he said that the quickest way to erase the U.S. deficit is to pass a law that says that any time there's a deficit of more than 3% of GDP, then all sitting members of Congress will be ineligible for re-election. And I do not doubt that would probably do it pretty quickly. In any case, the reality is that while U.S. stock investors like us will be impacted indirectly by this sort of thing over the long term, it's really, at the moment, much more of an issue for bond investors to have to navigate. And in neither market, neither the stock nor the bond market, does it represent any immediate risk. So a lot could change over 10 years, of course, and we'll just have to play it by ear and see what happens. So to step back, those last three slides here, this one and the previous two were sort of the big picture market-centric highlights of the tax reform or things to most note. And now I'm going to switch gears into what does this all mean for each of us personally. So again, from here on out, this is the impact of the tax reform on us from a personal financial planning perspective. So let's get into those highlights. First, from the corporate side, which is really where the most substantive reforms happened, and most notably the consolidation down to a single 21% tax rate here in the U.S., and the fact that, I did mention this earlier, the fact that the corporate-related changes were permanent. That's about all I'm going to mention here, and what is probably the most important aspects of the TCJA, at least in terms of the big picture impacts. I am at this point more interested in knowing what it means to me as a taxpayer, so let's drill down there. When it comes to individuals, this new legislation is more of a series of cuts and tweaks, which in turn, arguably introduce more tax planning complexity for most folks. And in contrast to that previous slide, unlike the corporate changes, which are permanent, the changes for taxpayers are subject to a sunset provision, after the year 2025. That said, the new tax laws do have a lot to like for individual households, almost all of whom will see a reduction in taxes in the coming years, although not after the 2025 sunset, unless extended. While 7 tax brackets remain, as we'll get into in a minute, most are decreased by a few percentage points to a new top rate of 37%. The AMT remains, but its exemption is widened. Most common deductions remain, though they are more limited, and an expanded standard deduction means fewer people will likely claim itemized deductions at all in the future. So there's a lot to the new tax law, obviously, and I just kind of cherry picked 6 highlights here that I think are probably the most relevant for most IIM investors. Ultimately, these new tax rules are complex enough that it's probably going to take months or maybe even in some cases years for all of the new tax planning strategies to emerge from this thing. So these are just the facts, and I will leave it to you and your CPA to strategize on what is best for you personally. The good news here for most married couples is that relative to today's tax brackets, the new tax brackets will produce at least a small reduction in marginal tax brackets for virtually all taxpayers, while the 10% and 35% brackets remain as is. The other 5 tax brackets all received a reduction in rates from 1 to 4%. One exception to that, though, which is circled in red here. If you and your spouse made just more than $400K, but just under $425,000, then though you used to be at the 33% tax bracket, you will now be at the 35% tax bracket after the reform. So, surprise. Also, though, and this is important, as per that footnote, which is good news for investors, the tax rates on capital gains and qualified dividends do remain the same. They are the same after the tax reform. Just for a little perspective, in the historical sense, this is how the highest and lowest tax brackets we've had in the U.S. have looked over time. You can see that the top tax rates in the U.S. In the past have been much higher, and especially during wartime. Okay, also under the new rules, the standard deduction will be $12,000 for individuals and $24,000 for married couples, as compared to just $6,350 for individuals and $12,700 for married couples under the 2017 law. The net of which is that this expanded standard deduction means fewer of us will likely claim itemized deductions now. A lot going on in this table here. I'll just kind of hit 2 of these items. The mortgage interest deduction is now capped at $750K. So probably something to consider at the margins, maybe for either folks who are going to buy or refinance, or on the other side, if you're in the banking and or real estate industry. I don't think that's enough to crimp demand by any means, but I guess you never know. Also, on the charitable contributions line, we do have investors here who run nonprofits. I think it's worthy to note that big donors can really now donate more. Their contribution caps have gone up there, so that could be a little boost for nonprofits, among other things. I'm going to skip ahead to a couple of screenshots here, and if you have questions on any of those things I skipped over, by all means fire away. Just trying to keep this somewhat brief. Couple screenshots of where on the Schedule A these sorts of issues will show up. Top and bottom, so just kind of tying or labeling some of those earlier slides 2, if you're a visual person, where you might see that on Schedule A. All right, now, if you are asking yourself, what is the AMT, then just consider yourself lucky not to know it and move on or something, I guess. The bottom line is that the end result of these changes is that we have an increased threshold for the AMT exemption phase-out, along with a higher AMT exemption amount itself. So while the AMT commonly used to impact those with between $150,000 in income to $600,000 in income per year, in the future, AMT exposure will be much smaller, and it will be hard to be impacted at all, especially given more limited deductions. All of which, to me, is that's a good thing, and then some. On QBI, qualified business income. The short version here is that there is a new rule that will allow pass-through business entities, i.e. Partnerships, sole proprietorships, LLCs, and or S corporations, to benefit from a lower tax rate. In practice, pass-through businesses will be taxed on only 80% of their pass-through income. And though these new rules have a number of restrictions in place around them, one of the probable consequences here is that for some small business owners, it may make more sense to get paid as a contractor rather than as an employee. There is a lot to unpack there in particular, so be sure that you talk to your CPA before getting too excited, but it is a notable change that may affect many of you independent contractors and or small business owners. So some interesting things going on with QBI for sure as well. This slide on 529 plans, it's probably most relevant to parents with kids in private school or who want to send their kids to private school. So for Islamorada locals, that would mean parents of children at ICS or St. Justin's or Ocean Studies Charter School, for instance. The bottom line for everyone, though, whether you're in the Keys or not, is that 529 plans can now be tapped to pay for private school too. Not homeschooling, that was not allowed in this reform, but private school, it is now okay, which I think is potentially interesting. If there's bad news for investors specifically in this bill, it's probably the change in this slide here, which basically means investment advisory fees on taxable accounts will no longer be deductible starting really this year, starting 2018. That is called a non-obvious consequence of a provision in the reform that strips out the ability for you to deduct any miscellaneous itemized deductions subject to the what's called the 2% of AGI floor. That same change also includes all tax preparation expenses, can't deduct those anymore, various sort of unreimbursed employee business expenses, most notably including the home office deduction, things like losses on a variable annuity, and just some general cats and dogs and other things out there. So it's not as if advisory fees specifically were singled out so much as they were just lumped in with some other things that as a class all got nixed, at least for individuals. Those sorts of fees are still deductible for businesses, but not individuals anymore. That said, keep in mind this applies just to taxable accounts, IRAs, just traditional ones now, not Roths, and other retirement accounts that pay their own advisory fees are still considered permissible Section 212 expenses of the IRS, and fees paid from a pre-tax IRA are, by definition, 100% pre-tax, which is the equivalent of making those fees a deductible expense, if all that makes sense. In any case, all of that in particular is good. It's just the taxable accounts in general that are impacted, and you're no longer able to deduct those advisory fees. Bummer. A couple of other changes here. I'll sort of pick and choose a few of them. On the estate and gift tax line, we did see with this reform a doubling of the estate tax exemption amount, specifically to $11.2 million for individuals and $22.4 million for couples, which really will make estate tax planning irrelevant in 2018 and beyond for everyone but the wealthiest of folks. So as much new business as this reform will create for CPAs, it will probably remove permanently for estate planning lawyers. Also, another highlight, somewhat relevant for other folks in the Keys still dealing, for instance, with the aftermath of Hurricane Irma. Personal casualty losses will now only be deductible if they were incurred in a federal disaster area. So small point, but just something to keep in the back of your mind. And then another one in there that's more realtor specific. 1031 exchanges, they are now limited to just real estate. Used to be a couple of other asset classes you could do 1031s with, but not anymore. The last line down there is probably the most important, that arguably may have even needed its own breakout slide. But the point there is a much wider range of families now will benefit from a greatly expanded child tax credit with drastically higher income phase-outs. So get yourself some kids. Not a lot of tweaks on the first page of the 1040 regarding some of those highlights I just hit. But on the second page, here are some of those flags I mentioned previously to consider and where they are on the form itself. If you prefer to think about this sort of stuff more visually. Okay, that's it. Those were the things I saw in this tax reform that I think are probably the most relevant for most IIM investors. Please fire away with any questions, or if I missed anything, you want some more details. I do have some more detailed material here with more specifics on tax reform if needed. The Wall Street Journal, for instance, did a special version PDF that's more comprehensive than these slides here and might help you drill down on some of these areas in these slides if it's of interest to you. And if so, just shoot me an email and let me know you want more info. Okay, hope this was helpful, and thank you for watching.